So at Capital One's Insight Center, drawing on the work that we've been doing with BCG, the Black Wealth Data Center, all throughout the pandemic, saw a particular need for a data source to fill in a gap in our understanding. A lot of the commitments that were shared before were talking about investments in the creation of Black-owned businesses. Starting those, we saw a dynamic growth in the number of Black and Hispanic businesses that were started throughout the pandemic. And the question was, is this actually a pathway to addressing the racial wealth gap? If we create more Black and Hispanic businesses, do they have the supports around them for that to be a pathway, not just for what we know Black business formation to be, but can it actually add to what we're all here to do and connect to the changes in wealth? So started on this research journey. We know historically business ownership, critical pathway to wealth creation. We know this across all sectors of society, but there was some data starting to come out. JP Morgan Chase Institute did a study looking at liquid wealth that was just showing that Black-owned business owners actually did not have the same level of wealth as people who did not start businesses. So we wanted to explore this question a little bit more. What comes first? We know wealth creation begets business ownership, but what happens in the other way around? Can business ownership really create wealth for the business owners so that they are able to transfer that and build and address the racial wealth gap? We took this study on in Richmond, which is a very interesting place. Historically, it's a place where if you are going to have thriving Black and Hispanic businesses, Richmond should be the place. Mid-sized city with a Black Wall Street there historically. It is a dynamic economy that is the birthplace of Capital One. And so if there is an economy, if there's a business ecosystem that exists that was able to create one of the nation's largest banks at this point, can it also be a place that creates thriving Black and Hispanic businesses? And so we worked with BCG over the fall to implement a survey, and I'll pass it over to Kedra to talk a little bit about that work.
Thanks, Shena. We are really honored to partner with Capital One on this work and really dive deep into this question and to see what variations we found in business ownership and wealth creation over time. We surveyed about 1,000 folks from Richmond, individuals, business owners, Black and Hispanic and non-Black and Hispanic, so we could have a source of comparison. We really did focus on those businesses that were less than $10 million in revenue. We were really trying to look at this question of small to mid-sized business. What happens to wealth creation in that period of time when you have a business at that scale, given that a majority of businesses in the Black and Hispanic communities are those smaller businesses? So really trying to understand the problem in a lot of detail. Average business years is about 12 years. Average annual revenue was 2.9 million. So we did have a long tail of very small businesses. Again, understanding their experience is really critical here. And we looked across sectors as well. So one of the things that we found is that for about a third of the Black and Hispanic business owners we surveyed, they achieved $188,000 of wealth over their course of business ownership. We use that number because it is the median white wealth number for a white family in the US. So could we achieve that benchmark through business ownership? We found that about a third did. One of our key questions was, well, what under conditions is that happening? And for those that did not achieve that number, what did that mean? We also found about half the businesses that we surveyed achieved $100,000 of wealth or more as well. And so, yes, certainly wealth creation for some businesses was possible, but what were some of the conditions under which that would be successful? We also looked at the other roles that businesses play in community. So certainly this is about personal, family wealth creation and wealth generation that can be passed down, but it's also about how these businesses contribute to communities. Someone earlier talked about, I think DeBaun from McKinsey was saying, if the needs of Black and Hispanic businesses, our communities were served well, we'd be generating much more revenue in these communities. And so certainly funding these businesses, supporting the growth of these businesses is critical for vibrant communities. It is also critical for economic growth. And in Richmond specifically, we found a couple of things that I thought were very helpful to understand. So one, we know that 75% of small business revenue stays in the local economy. We also know that overall employment in Richmond, about 65% of that is accounted for by small and mid-sized businesses at less than 250 employees. So these businesses are playing a critical role in the local economy. We also know that about 65% of new jobs in the US and 48% of overall jobs in the US are created by small businesses. So we cannot ignore the critical factor these organizations play. And what we also found is about 40% of the businesses that we surveyed had 10 or more employees. So these are folks that are supporting personal wealth creation for their families, but also providing income on a sustained basis for an employee base in Richmond. So we confirmed a couple of things, but I think the magnitude is really critical. So I think we would all say businesses that stay open longer, that survive over the long term, should create more wealth. We found what was really important was to look at what happens in the first 5 years, what happens in 5 to 10 years, and 10 to 15 years. And that 9x increase between 0 to 5 years and 5 to 10 years, we think is really critical as we look at the growth of those businesses. So if we're not talking about sustaining businesses over a long period of time, we're actually not talking about wealth growth. We have to be really focused on sustaining businesses, having them survive, having them grow. And Shena will talk a little bit more about that growth.
And so we found here that owners of large businesses experience more wealth growth, which is kind of an obvious finding for us to have, that size played a factor in the ability to attract more resources and to translate that into wealth. The most disturbing finding that we have here is that wealth creation is not a guarantee for all business owners. And this is something that should give us all a little bit of pause and to recognize that there is risk involved in business ownership. And this is why it's so incredible that we're not asking entrepreneurs to just step out there alone without the ecosystem to support them and the resources, the advisors, the professional services that we talked about earlier. This lets us know how critically important that is for business ownership to be a pathway to wealth creation for that business owner, and then ultimately for business ownership to be the driver of the racial wealth, of closing the racial wealth gap that we know that it can be in our communities. Looking at this, we see that non-business owners actually grew more wealth through the pandemic period than small business owners. We know the hit that they took as business owners through this, but this is the survivors. These are the successful businesses through that time. And they, even through that period, were not able to keep up with the wealth gains that non-business owners had. And so this is the message throughout this presentation is we want to understand what it really takes to support business owners for them to realize the wealth gains that non-Black and Hispanic business owners are gaining through business ownership.
I'll just call out one other point here. We also found that Black-owned businesses gained only 1/4 of the wealth that white-owned businesses did during this period. So as we talk about the racial wealth gap and closing that gap, if we're not at parity or higher in terms of wealth growth over periods of time, it's quite a challenge. And that's also why we talk about businesses surviving and being sustainable over more like that 5 to 10 year, 10 to 15 year plus period. As we think about recommendations to move forward, and we'll talk more about this on the panel, there's a few things that we found differences in. We really tried to dig into what drives wealth, what are the true differences, and it wasn't industry necessarily, it wasn't even prior wealth. It was things like initial and growth funding, capabilities and expertise, whether formal or informal, and then a coordinated ecosystem, which is really critical when we're talking about small businesses in a place-based way. So from a funding perspective, we found that businesses that received growth funding, of course, were more successful in terms of their wealth growth overall. We also found that on the initial funding side, businesses that received full funding versus only partial generated 3x the wealth than those that did not receive full funding. And so we know that for our communities, funding is incredibly critical. We may not have family and friends networks that we can pull from, and so really looking for external sources of funding is really important. We'll talk more about that on the panel in a few minutes. As we think about capabilities, we certainly found in talking to a number of entrepreneurs, finding ways to grow operational capacity, making sure you have access to the skill sets that you need, it's really critical. John Rogers earlier talked about business diversity and access to markets, so not just the B2B piece around getting entrepreneurs in the Black and Hispanic community into the supply chains of large corporations, but also giving them platforms and channels to access more consumers so they can drive more revenue in those ways. And then advising and expertise. We had a conversation at some point about the invisible scaffolding that supports any business. If you look at your corporation, you have consultants, you have accountants, you have lawyers. Any business to be successful and grow over time needs these supports. And often we ignore that part of the conversation, I think, for Black-owned businesses that we need to dig into. And then there's the ecosystem. Really thinking about the supply side of businesses, the demand from B2B organizations and also consumers, and needing the market support, the support for MBs to grow over time, also the policy and advocacy that's necessary to ensure that we're creating the right incentives from a policy perspective to drive funding and support of these organizations, and then of course, education and talent. These are some of the recommendations that we'll dig into more in the paper. I do want to make sure we get to our panel, so I won't go through them in detail. But certainly funding is a big piece of this, which we'll talk about more about in a moment. Empowering businesses, not just through training, but also through tools and digital tools that allow them to keep track of books, records, to make that overall process more efficient. Ensuring more trust between funders and communities of color through more transparency and more collaboration. Increase access to flexible and small-scale funding for businesses that they're starting out, which today relies most often on personal credit, so thinking about other ways to expand access to funding. And then, of course, helping community organizations. In Richmond specifically, we found that the coordination across organizations needed more attention. It was hard for organizations to reach businesses at the point in time they wanted to really connect with them early on, and also difficult for the entrepreneurs to navigate that local ecosystem of supports, even if they were there. And then lastly, and we'll talk about this a little bit more in a minute, building purpose-built capital and credit access opportunities. So when we think about things like alternative data, we think about how we assess businesses to advance credit and creditworthiness assessments, really thinking about purpose-built ways to do that with intentionality around the equity challenges that exist as we go into that process. That's great. Thank you. We'll step up here and start our panel.
So there were so many different insights in that presentation. I wanted to just get some clarity on a couple of things. One, when you talk about wealth, what was the definition of wealth? Was it savings in the bank account, or how did you all define wealth?
So we did focus on wealth in terms of personal assets and debt. We were not looking at the valuation of the company per se. We're really talking about how does business ownership impact the household wealth of the founder, of the entrepreneur.
Okay, that makes sense. And then in terms of funding, when you're saying that some of the businesses were receiving funding and some weren't, were they loans? Were they small investments, friends and family? What were you all seeing in the research?
So we requested information across kind of all the various sources of funding. Are you receiving loans? Are you receiving friends and family funding, equity investment, et cetera? So we looked across the full landscape of funding opportunities. When we talk about funding here, we are talking about external funding. So funding coming from a CDFI, a bank, a grant, really trying to understand how does external funding that you did not already have in your pocket influence your wealth growth over time as an entrepreneur.
That makes a lot of sense. Melissa, I'm curious, given your experience on both helping small business owners and then also now being an incredible VC, what were your biggest takeaways from this research?
So one, let me say, this is a beautiful looking crowd. Telling y'all, it's nice to be out again. I think that there were things that I could say amen, and there were things that I was like, I have the privilege not only run 863 Ventures, but be a professor at Georgetown. And so it echoes a research study we just did called Beyond 5, where we realized that majority of businesses fail within 5 years, but Black businesses actually last 8.5 years. Now, unfortunately, that longevity does not always correlate to wealth creation, so this was spot on. I also think that the access to capital versus profitability. For many Black businesses, because we don't have access to capital, it's all about profitability. And so it resonated in many ways, and I think in the vein of this conversation, I think there were three things that I think are important as we have this conversation. I think one is that, I think there's a lot of focus on entrepreneurship, but not everybody knows what it is. And there's such a broad definition. And so one of the things when you talk about training and access, I also think there's a level of cultural competency. So it costs a Black entrepreneur at least $250,000 more to start the same exact business as their white peer. That's because we churn through mentors, because we don't get them for free, because we don't get into accelerators, and because you can legally be charged more for a bank loan. So I think really being mindful that entrepreneurship is a pathway, but it's not for everybody. And there has to be certain levers that are pulled at the right time. Otherwise, you'll find that entrepreneurship tanks people because we give away most of our cap table before we get to a Series A, because we borrowed against our house and we pulled out our retirement savings because we want to be bootstrapping. But everybody else is just calling their friends and getting a $200,000 check. And I think that decreases our wealth. I think the second thing is also being mindful that we're in different industries. So this kind of business diversity, just about 20% of all Black businesses are tech businesses. So this idea of like, let's do everything tech is great, but we're leaving a lot of historical legacy businesses behind who historically have relied on supplier diversity. And, that's comes and goes depending on what's happening in the news. But how do you really then lever up businesses? And statistics show that if you're a one staff person business, you're the founder, you average around $47,000 a year. As soon as you hire another person, you get $387,000 a year. And so I think we've lost the focus on getting more capital as opposed to how do we create jobs? Because that's the economic driver, not just for the owner, but for the Black community. And I think the final thing I would say is we need a lot more research. We are oftentimes historically overlooked, not just in access to capital, but in terms of data. And there's nuances here if you're a Black man versus a Black woman, recognizing the fastest growing segment of entrepreneurs are Black women, but we are the most underfunded. And how can that be? Well, because we heard in the earlier panel that we're always at the bottom. And so I think there's a need to understand we need to do more of this. If people in this room can support it or be involved in it to really understand gender, geography, I would imagine this would be very different if we were in Silicon Valley, and also understand business diversity as well as age, right? The average Black female entrepreneur is 42 years old. So we have to change the picture. There's some great kid coming out of undergrad, because most of us as parents say, could you go get a job first? But I think we've got to now dig deeper so that we can align capital and resources to support them.
And can I just speak to the job creation point that you made, Melissa? In this sample, that was one of the real benefits that we saw through this, where even for the businesses that were not wealth returning to the owner, they were creating jobs. For most of these businesses, 10 new employees were created. And so we're also thinking a little bit more about what wealth returning means for these business owners. And is it about their personal wealth, or is it creating opportunities for others in the community to have jobs as well? I think that's a part of the nuance of what Black entrepreneurship and Black business ownership might look different than it does for the average population.
I have one more point to that. I think also sustaining the business is about that employment. You may not gain additional wealth, but if you're able to pass on an asset to the next generation, that is another way to pass on value. We focus very much on personal family balance sheet, if you will, when we define wealth here, but certainly creating a sustaining asset that could be in the community for a long period of time and create stability in that community with jobs, with presence, and then being able to pass that to the next generation is also a critical part of this. And I don't think we understand in detail the economic impact of that for communities as well.
I think a lot of entrepreneurs do start their businesses because they want wealth, though, right? So what were the things that you saw in the research that were attributes that you think policymakers and others need to know in order to help entrepreneurs generate that wealth for themselves and for others?
I'm happy to start. I will come back to the funding point because I think that is critical. Profitability and performance are absolutely what we have to focus on as entrepreneurs, but getting funding is critical to ensure that you can grow over time. And so that funding piece we think is really, really an important piece that we can't deny. Knowing that those entrepreneurs that received their full funding versus partial funding as they were starting out attained 3x the wealth of those that only had partial funding is a really important piece of this. The same is true of growth funding in terms of impact, and so that funding piece is critical. We think funding across the spectrum of options is really important to look at as well, and so whether we're talking about CDFIs, grant dollars, or traditional loans, that's critical. On the traditional loan side, we'll talk a little bit more about this in the paper, we really focus on this idea that we need innovative credit worthiness policies. If you're starting a small business, we're really relying on your personal credit today. And we know that in our community, lower credit scores, lower assets, less collateral to offer, it is quite challenging. And so really thinking about how we can innovate in credit worthiness assessments, especially in the small business space, we think is an important lever.
Yes, and I'll just add to that, expanding the aperture. We're looking a lot at the new capital flows that are going to small businesses for them to grow those businesses. But we also need to be making that investment in the accelerators and all of the supports that happen around those. Richmond is a community, like so many that we see, that's rich in support services to small businesses. So even just having them is not enough. Making sure that we can connect these business owners to those resources, create pathways in real time. This is why we think digital technical assistance will be such a game changer, because people need to be able to do that asynchronously and to get the education and supports they need on a time that works for them while they're balancing business and family, often at the same time, given that so many of these business owners are young women.
Melissa, in your experience, when you see small businesses, Black small businesses that are able to hit that inflection curve where they have durable wealth, what are you seeing as the differentiators for why they're able to scale to 10 plus employees, scale to 10 plus million in revenue?
Yeah. So I think there's a few things. I think one is, I'm going to say, mentorship and stewardship. If you think about I don't know if he's in here, but if you think about the exit of Mael, being sold to P&G, that was money, but it was also because you had somebody like Rich Dennis who had done it himself to be able to lay that framework. So I think having folks who are willing to reach back and say, let me tell you how it's done, because we've made this assumption that because you're on Shark Tank, everybody has the same path. I think the second thing is, we keep talking about capital, but it's important to have the right type of capital. It is extremely frustrating to me that when I see a Black female coming to a Series A, she's lost 40 to 50% of her cap table already.
That's right.
So we do revenue-based financing. On the next panel, you'll hear from Jewel in terms of what she's working on. So I think we have to understand not all capital is good capital. And because I find that many of our businesses are making the investors wealthy, but not those people. And I think the other thing I would say that really caused that trajectory is having training. I think just because you have a business degree doesn't mean you know how to run a business. And so we focus a lot at AC3 of how do you move somebody from a founder to a CEO. So we don't even talk about pitching. We talk about, do you know how to hire people? Don't hire your best friend first. It's not going to work. Do you have operations and systems? Because that's a huge mindset shift. And I think that really comes full circle to, I have to be able to have seen it in order to believe it. And so a lot of it is, how do you instill confidence? How do you demonstrate precedence? And how do you make sure they don't over dilute themselves too soon so they can actually recognize their gains?
Absolutely.
But I want to say, because you do this all the time, so what do you think?
I think that my experience at Blavity, we have 200 employees, most of which are Black and majority women. I definitely think that once you reach an inflection point of sustainability, I chose not to raise a Series B, a Series C, because to your point, I wanted to continue to own my business, and the terms for Black entrepreneurs are much, much worse. But that presents different problems, right? Because then you have to go get debt financing and lines of credit. I think once you reach a certain level of success as a Black entrepreneur, people wrap their arms around you. It's actually very difficult to fail because so many people are rooting for you. But that seed to Series A, I see so many people fall out of the pipeline because it's really difficult for people to lead your Series A. And many white VCs don't want to, because they take a board seat. They're with you for 5 to 10 years. And the Black VCs, their funds aren't big enough to lead. So there's a lot of things that go into, in my experience, some of the challenges for people being able to continue to raise funding. I think this research study is helpful for small business owners, but I imagine when you look at venture-backed, it's going to give you a little bit different. I think wealth creation is huge. I've got a lot of friends doing quite well. But for small business owners, I see so many people who struggle to even navigate how to get a loan, right? It's not like you just walk into a bank and say, hey, I need $100,000. I remember I tried walking into a bank and I was, first of all, so nervous. I didn't know what to have. I didn't know what a P&L was. I didn't know any of that stuff. And so, eventually we actually did do revenue-based financing off of our accounts receivable, but the interest rates, are not advantageous to us. It was quite expensive. Yep. So, I've had all of the experiences, and I completely agree that it's important for organizations to be solutions-based. And I think this research study is so interesting, and I hope that, and I'm curious actually from your perspective, what are the recommendations for those of the people in the room that are leading institutions that can actually make policy recommendations? What do you think will actually work? Because I hear a lot of discussion, but I'm curious what you think will make an impact immediately and not something that will take 5 to 10 years.
I go back to this phrase Kedra raised about that invisible scaffolding. And I think part of it is that narrative shift to recognizing that We're not asking for anything different for Black and Hispanic entrepreneurs, but we're asking that they get the same opportunities others get. And telling more about this isn't the lone entrepreneur who did this in his basement and came up with this. They have some scaffolding around them that's creating that. And we just want that same scaffolding to be there to help someone when they go in and ask for their first loan, to know what to ask for, what your books should look like, how are you prepared to enter that conversation. I think that's a big shift that we need to do in terms of the resources that are incredible moment right now for public policy investing in small businesses, but we want to just point some of that attention toward the supports that are needed around these business owners. Kedra, anything to add?
I won't beat on my creditworthiness drum again, but I will say, Morgan walking in and asking for a $100,000 loan versus her colleague who has a family, who has 3 homes that they can put up as collateral. It's a very different picture. And if we're being intentional about closing equity gaps, we have to recognize different starting points and innovate our processes to address that. And I think that's one of the challenges, I think, in traditional industry and traditional banking, is recognizing that we built corporate policies and practices over decades, over, for some organizations, hundreds of years. Those are very much ingrained in how they work. And so if we're not focused on what are the policy and system changes we have to make these things possible, then we're not going to start to close those gaps. And then lastly, I'll just say on the business diversity side, as we get into larger businesses, I think each person in this room that works for a corporation, ask those questions. Ask your procurement team, how do we think about business diversity? Are we tracking that data? What are we doing to ensure that we're in the conversation when the decision happens or before the slate of companies selected for those conversations? Really, how do we change that process? Because there are the B2B dollars that are spent in this country is a critical part of the economy that we're currently being left out of. And so if we're not really focused on that across all sectors, consulting as well, finance, accounting, legal services, we're not really thinking about how we close the wealth gap in those higher margin industries, as John mentioned earlier.
I just want to say that my hope is that we have more rigor in a couple different areas. One is that, respectfully, if you ain't done it, you can't tell somebody else how to do it. So we need to bring a little bit more rigor to who gets to say, who gets to be an entrepreneur. Yes. Because it's a very, the risk tolerance of somebody who has $1.5 million budget versus somebody who has $1.50 to get to the VC meeting is very different. I think the second thing is when you talk about policy, obviously the Department of Commerce and the MBDA are now deploying a lot of money, but there's nothing in that rubric to assess the nuances of serving a Black entrepreneur. And so just because you've served a bunch of white entrepreneurs doesn't mean you know how to serve Black entrepreneurs. And so I think we've got to think about what are some different asset-based strategies to be able to discern what's going to work best for our communities. And then the final thing I would say is that we as Black entrepreneurs and Black investors have to be much more intentional about our language and how we demonstrate the success that we had. It's not about the number of zeros, to me, that's at the end. It's about the journey, because if you then recognize the journey and then you find the right moment to pivot, you can scale what has happened. And for me, it's extremely disappointing that in some ways we're still having these conversations, because this country knows the value of Black people. Black people were the underlying assets that set up most of the banks and most of the institutions, namely the one that we're sitting in. And how dare you then tell me now I have no value? And so we need to move from being the asset underwriters to the asset holders and the asset owners. And people have to understand their history to understand why it's important that when a bank like Citi says we've lost $16 trillion, we've actually lost $300 billion in this country because we have underinvested in Black entrepreneurs.